Hi there, and welcome to our end of October edition of On Track, where I update clients of McGregor Wealth Management on what's happening in the world. Now, this is designed for our clients, that is, clients of McGregor Wealth Management. Those of you listening who aren't yet clients of McGregor Wealth Management, you're welcome to enjoy the information contained in here, but you should not act on anything I talk about without getting advice that's specific to your own circumstances. I'm going to cover in today's On Track some important economic news, and it's been a big month, fairly positive as well. I'm going to put it into context, what's happening in the market. We'll do some key updates on that market, and as always, we'll put it in perspective as to what it means for your portfolios. So the news highlights, and we're still news being dominated by the virus, although we had only two topics, and it's November 30th as I record this, and we've had two topics for most of the year here, coronavirus and the US presidential election. Well, we're getting closer towards the end of both of those. So the US election, we had a result, kind of, even though Trump has not officially conceded. He's allowing handover to Biden, and we'll see. Watch this space, but it looks like there'll be a transition to the Biden-led Democrats. The markets have looked at that as fairly favourable for a few reasons. One, they believe the stimulus that the Democrats will provide will be good for the market. Two, they believe a bit less craziness is probably going to be good. And my third bullet point there, they're starting to appoint some very experienced heads into positions. Now, Trump had a track record of appointing the people he wanted, and if they didn't do what he wanted, he sacked them. You're fired, the Trump reality show, whereas I think Biden will go back to appointing experienced heads. Now, that's a good thing. Trump might argue that's a bad thing. It's the insiders of Washington. But his appointment as the head of Treasury of Janet Yellen is very much a positive for the market. She's the former Federal Reserve chair and very well respected, and her announcement was greeted with market going up as safe hands. Now, the second one nestled in there, we've had three companies report that their vaccines are heading for high efficiency, 90% plus, and these are excellent results. This puts them in the top tier of vaccines for anything, whether that's flu or measles or whatever. But when we see 90% efficacy, it's a very high result. So all of a sudden, the market's starting to say, well, it looks like we're going to have a vaccine. Looks like we'll get out of this. Now, how long it takes to ramp up the vaccine and how long it takes for most of the world to start getting vaccine, how much the take-up is from individuals, remains to be seen. But you would expect that by over 2021, more and more people will take the vaccine. And I think it's going to be a condition of travel. So that will mean anyone who wants to travel, certainly out of Australia, but certainly to most countries around the world, it's highly likely that will be the case. So that was good news. The October numbers I'm going to report on were before both of those things. So we've seen a savage increase in the market since the end of October, which I'll touch on. And that's seen the Dow Jones make all-time highs, higher than their previous peak. Not all good news, mostly good news for this month, but we do see escalating COVID cases heading into the Northern Hemisphere winter. Even though those cases are escalating, though, there's a declining death rate for whatever reason. And with the vaccine looming, I suspect that we'll see cases for 2021 drop. And one of the most important psychological factors around the vaccine is that the world will stop focusing on this one thing. So 2021, certainly since March, we've pretty much had one focus that's dominated conversations, dominated market assessments, and that's been the virus. As the vaccines developed and roll out, it will become less of the thing that we focus on, and that will mean we'll get back to other focuses, which will be good for many, many reasons, and one being the market. And we're seeing locally, as state budgets, state governments in Australia release their budgets, a ramp up in spending. So we're seeing spending, and more spending, as I talked about last month. That's good for the market. It's somewhere down the track the piper will have to be paid. But one of the reasons governments, both local in Australia, as in state governments in Australia, plus the federal government in Australia, but also governments around the world, one of the reasons they can spend confidently is because of the numbers on the right-hand side. At the moment, a 10-year government bond yield is sub 1%, and that's gone up a little bit last month. This is the numbers right now as I speak on the 30th of November, so there's been a little increase due to the positive news. But look at 90-day bank bills, RBA cash rate, we went to a fraction of 1%. Inflation's below 1%. Mortgage rates at 2.5%, and we're starting to see advertised mortgage rates. I think it's NAB and CBA have 4-year fixed home loans at 1.98%. So you can lock in a home loan at 1.98%. Quite amazing. And the bad news for retirees who aren't long-term investors in shares and funds is term deposit rates are plummeting below 1% fast. And it's only if you chase specials that you'll see rates sort of just over 1%. So, and I'll talk more about each of those, but back to those bond rates, governments are able to borrow at 1%. So no matter how much they borrow, for the moment, their payments on that are fairly low. And if the government borrows now with a 10-year fixed bond rate, they'll only be paying less than 1% for that. And that's locked in until they pay that back over the next 10 years. Still got to be paid back, but it's likely that'll be paid back from two sources, and that's down the track will be rising taxes on hopefully rising prosperity for the economy. What's that meant for returns? So I stress these are to the end of October. We've nearly finished November. It looks like November is going to be one of the best months on record. In fact, if it closes where it is at lunchtime today, on the last day of November, November will close as one of the best months since 1988. So put that down to no more Trump and vaccine, hopefully no more virus. I'll let you make your judgment on both of those, but the market has spoken. So 1 month returns for the month of October were fair, so ranging from 0.5% for the conservative portfolios up to 1.5%. That brings the 1 year portfolios almost back to flat, and they're pretty much all close to square now in the subsequent month. And we're seeing 5-year returns delivering pretty close to the long-term targets, above for the more conservative portfolios and just a fraction under for the growth and high growth portfolios. But when you factor in active portfolios, etc., we've got fairly good returns over the 5 years to end of October, considering the year that we've had. As always, let me wrap up our framework. We talk about the market going through 5 stages in no particular order, but in a very specific order: boom, bust, and the wall of worry. Booms are always followed by busts, not the other way around. And most of the time, though, the market's in the wall of worry, where it's worrying all the time, but it worries up the hill with positive returns. So our current classification of the market, well, our classification at the end of the market was for the market to be fair value. It's probably a nudge over that at the moment. Given the hard run it's had, you can see where my cursor is there, but that was just before the US election. And it's funny how markets often sell off before an election. We saw the same thing in 2016, but literally from just a couple of days before the election, up 10%, which will make November one of the best months on record, and certainly the best since 1988. Look how far we've come. I've highlighted there the low of 23rd of March 2020. And I remember, I think one of our on-tracks was produced on the 24th of March, and it was indeed dark times. That was before governments announced all their spending, the job keepers, the job makers, and all the rest of it that's happened around the world. So subsidies that proved to be very good policy in hindsight. And we're not out of this yet, but it stopped that crisis stopped the market staying down. But more importantly, it put life into the economy through cash flow that's allowed a much quicker recovery than even I was thinking, particularly now that we've had the vaccines looking quite promising. Now keep in mind, and this shows that the COVID downturn we've been through in 2020 is the 5th worst downturn in Australia's share market history, and you can see the other ones here, from 1983 being the number one, 2007 being the number 2, etc. But the recovery here will be one of the quickest ones on record. and certainly, it looks like where we are at the moment, we're just a fraction under where we were at the start of the year, just over 6,000. We're still below the 7,000. We'll talk more about when we might see that. It doesn't matter for long-term investors. It only matters for those of you that are on the verge of investing more money or potentially pulling lots of money out, and I'll touch on both of those. So we believe the market's just slightly over fair value at the moment, and the pendulum is quite clearly in the middle. Still enough fear around, but certainly not FOMO, and we're certainly not in any boom as indicated by those 5-year performances. Every boom that we've had on this chart in the lead up to those downturns has seen 3 to 7 year performances of 15 to 20%. We're about 6 at the moment, so that tells us we're not in a FOMO state. Our CARE philosophy, which is utilised by most of you, has done well, and that's and it's done well not only performance-wise, but to keep you informed of what you've got and why we've got it. In those performance numbers, that active portfolio has performed quite positively. If you look over the last year, that active portfolio at about 3.75%, and that's a 100% growth portfolio. So it's achieved a positive return despite share markets being down, and you can see the Australian equities and international equities down 6 to 8% over that year, and that active portfolio has performed positively, partly because of gold, and I'll talk about gold when we get to the gold performances. But yeah, and look, the reserves portfolio has been absolutely critical in allowing retirees to continue to draw out their monthly pension payments and pull money out as planned without selling good assets at a bad time. Now, for my monthly topic, I'm going to focus on some that we've ignored. We've been so obsessed with the single issue and the short-term focus and the media and the emotional that I want to remind us of a couple of good long-term things with a couple of articles and charts that came across my desk during the month. And the first was a reminder. I'm reading a book at the moment, I'll talk about it in a minute. Reminder about the fact that timing the market is pretty much impossible. The funds that attempt to time the market are called hedge funds, and hedge funds, literally billions and billions and trillions of dollars invested in hedge funds. Back in 2008, Warren Buffett issued a challenge to the hedge fund industry in that he believed a simple index fund investment, and in this case it was the S&P 500 in the US, would beat their hedge funds. The head of one of those of a hedge fund group took him up on that bet, and he was allowed to pick 5 hedge funds that were his competitors to beat the index fund. Now keep in mind, this was in 2008. This was before the market downturn. So in the first year, the S&P went down nearly 50%. So it wasn't a good start for the index fund, but over the next year's index fund slowly marched ahead. You can see the results of the hedge funds. The average hedge fund, this is cumulative return. They gave up the bet 9 years in. It was a 10-year bet, and the money was invested. It was $1 million bet, and the money was given to charity. And you'll see the average of those hedge funds, just 22% cumulative. So that's really not much more than 2% over that time. Now, the index fund was up, and I've cut it off there, but it's about 85%. The best performing fund out of the ones that the expert on hedge funds was about 62% cumulative. So it shows you that even those smartest industry titans that lead up top hedge funds of the world couldn't beat a simple index investing, which is why we use index for about 70% of the portfolios. To re-emphasize here, and both that stat and this stat I'm about to go through come from a new book out by Peter Mallouk and Tony Robbins. Peter's an advisor in the US. Tony Robbins, the motivational or personal development guru, and fast approaching a billionaire himself. But Tony's been passionate in the last 10 years on writing books for everyday people on how to invest with some partners. They're very good books too, I must admit. And just going through that. But there's a nice chart in this one that shows you why people do underperform when they're attempting to time. And it's really simple. In a bull market, and this goes some has a look at some stats here. In the early 90s in the bull market, the average equity weighting for investors was about 34%. at the peak of the bull market in 2000, and in the States this was driven by the tech boom, that crept up to about 62%, and stock funds in the previous 2 years had inflows of 393,000, with only 5,000 going to bonds. So in those last 2 years of that crazy market, all the money was going to stocks right before disaster. And look what happened at the bottom of that market. So 3 years later, they'd gone back to about 40% equity weighting. The market had dropped 29%. And in the next 2 years, after the market had gone down, 221,000 went into bond funds and only 71,000 into equity funds. So the masses were putting money in during a boom and pulling it out when the market went down. A surefire way to lose money. Same thing occurred in the GFC. Equity weightings crept up to 62%. Stock fund flows, money going into stock funds, went ballistic. Not much into bonds, and then look, everything out. Ironically, bond funds out there as well. Flight to cash, but people pulled money out as the bear market bottomed and equity ratings dropped down again. So the masses behave irrationally. They charge money in as markets get expensive, and they pull money out as markets get cheap. And that's why it's so important for us to have our framework to know where we're at. We're absolutely in expensive to FOMO in both of those bull markets, and we're absolutely averaging in for clients at those peaks. In both cases, and you've seen articles that I've written both in 2008 and recently that talked about, as markets bottomed, encouraging people to do the opposite of what the masses were doing, which was investing. So an interesting proof of what the masses do and how collectively dumb we are as masses. This is a chart that comes from a company I love, Spiva. So they look at performance of active funds. So these are funds that attempt to beat the benchmark, to beat the index. And you'll see all around the world, it's unanimous, not many funds outperform the benchmark. Ironically, South Africa has the best stats here. Chile, not so good. The number's about 80% on average, and that's the Australian number. That's pretty close to the US number. Poor old Canada, 97% of funds fail to beat the benchmark over 5 years. And in pretty much every country, if you fast forward out to 15 years, it's less than 4% of funds actually outperform the benchmark. So not something that's worthwhile considering fees. And it's certainly why, once again, we use index as the core. Our friends, we've been talking about that phenomenon for years, and we often quote Delbar, and quietly during the COVID year, the Delbar Study, as it has done for the last 40 years, came out and shows two things that are persistent and that we've talked about for years. One is that people just do not hold on to their active funds for long. This is the retention of active equity funds in the US, sourced by Delbar. So it never gets longer than about 4 years, and drops, as I said, during the lowest points there during those bear markets. So what's behind that? Effectively, people get into funds when they're outperforming, and then 4 to 5 years later, they've lost confidence because that performance is just often not there. And it's said all the time, past performance is no guide to future performance, and it's particularly true for active managed funds for all sorts of reasons, but they just don't outperform progressively from year. And this is something that is a reminder to me of the value of getting this right. So in the last 30 years, consistently, we've seen the average investor perform 4 to 5% under the index. And that's because they don't hold funds for long. They try and pick winners. They put money in when the markets are booming, and they pull it out when it's down. That's what we call investor behavior. So the penalty for that, 4 to 5%, nearly 50%. So in a world that might yield 7 to 8% returns in low inflation, that penalty is likely to continue to be 3 to 4%, and that makes a massive difference to your plans. I'm pleased to say our average investors do not share that gap. They actually get the return of long-term investors through our careful and care process. So let's have a look at the October results. Aussie shares up 1.88, but have a look at, there's that, I've plotted out there, that's where The market was, as we went into the US election, at 6066 and finishing, yesterday about 65, almost 66. So nearly a 10% return for November, which followed on from the 1.8% return of October. I've thrown down the bottom here the top companies in the ASX 200 index, and it's interesting to look at their performance and what a difference. Have a look at the banks. CBA flat, National Bank down 9%, Westpac down 16%, ANZ down 7%. So for many retirees that go it alone and do it themselves, they have a tendency to have too much in bank shares, and they've had a terrible year with bank dividends cut as well. Some big performances, obviously Fortescue Metal, the biggest one there. Wesfarmers up thanks to Bunnings, the Bunnings factor. CSL, a good year thanks to the vaccine. And CSL is one of the potential manufacturers of the vaccine. They've already started building the plants and the factories that are going to spit out those vaccines. But yeah, the hazards of trying to pick stocks, who a year ago would have picked the year that we've had. And just wanted to also focus, I've got the 10-year returns up for this month. The ASX went into the start of 2011 at about 4,500. So it's finished 10 normally volatile years, 6,500. So it's up about 40% in value. But in that same time, Australian investors have had a 5% dividend yield. So up 50% nearly, plus a 5% dividend yield. An extremely good result for long-term investors that stuck to the strategy and didn't try and pick funds that would outperform or pick stocks that would outperform. US shares, much the same story. US shares, and this is in Aussie dollars. US shares in US dollars are actually past the peak, but in Aussie dollars, they're slightly under the peak, similar to Australian. But look at that chart, that 10-year chart from 2011 all the way up, actually up, nearly about 3 times in that thing. Now, the comparison is not fair because US companies just do not pay the same dividend. So while Australian companies pay, on average about that 5% dividend, US markets closer to the low ones. And you'll see the top stocks in the US market here in terms of, and there's their performance here, and Microsoft up 42% for the year, Apple up 74%, Amazon up 74%. Some amazing results from those big FANGs, as they call them, Facebook, Amazon, Google, Microsoft and Apple, the FANGs, that have outperformed lots of other, and even Warren Buffett, we talked about him before, but he's had a 5% year, not too bad. And diversification means you own all of those stocks plus many more. US small caps actually down for the year, up 4.66% in the month of October, and they're going to be up another 10% at least in November. So you're going to see some great performances in November when those numbers are closed off, and once again, great long-term returns for the patient investor. Global leaders, this is the top 100 companies in the world, also a good recovery. Ironically, not so much boom in November, and that's partly, it's jumped up a lot, don't get me wrong, and partly you'll see why when we get to gold, and it's partly because those companies I talked about before, Microsoft, etc., there was a little bit of profit taking after a big year, and what they call a rotation, where people rotated from the companies that have been leading, Microsoft, Facebook, Apple, into more regular companies that had been lagging. So that's seen a bit more of a flattening off there. Actually had a slightly negative October in the lead up to the election, full recovery from there. Emerging markets, it's actually been a solid year. Emerging markets are actually up 5% for the year. They're up 3.5% in the last month, quite amazing, and that's before November. November they're going to be up about 8% if the market closes roughly where it is. And they've also had a solid decade, up about 50%. They do pay reasonable dividends as well. And they add another important diversification factor. Gold, which is our insurance policy, and look at gold, it's tumbled off the cliff as Trump was evicted. As he was started to be evicted, The gold price just has gone down. And that's the market saying the market isn't as risky as it was. You'll see the gold price went straight up during the COVID year and the uncertainty that was around in world politics, and we're seeing that fall down. And that's a good thing. I mean, we actually don't mind. Gold actually went up for the month of October, but down, and that's this month right in here, so it didn't go up by much, but it's going to be spectacularly down in November to the tune of about 10%. Now, gold is literally, for most people, 2 to 3% of their portfolio. So it being down 10%, while equity markets are up 10%, is actually a good thing. It's a good thing when you don't need your insurance policy. I put this chart in again. I had it from last month on track from the budget. So this source is the Australian National Accounts, because it shows GDP here, and I'm going to go back to something I didn't point out at the start as well, but it shows GDP dropping massively back to 2017 levels. That's what markets did, and then it shows it projected to recover to its pre-COVID levels somewhere in mid-21. Now the markets probably brought that forward, and that's why the markets jumped up so quickly. One of the indicators, and let me just go back to where I started, and on this news highlights, I put in here the PMIs. So these are the purchase managing indicators. So this is what purchasing managers in companies around the world are doing. So they stopped ordering literally as COVID started. So that was a predictor. This is what they call a leading indicator. So it's an indicator of what's coming up. So that it predicted absolutely a smashing of global GDP, but then bang, and you'll see it quite positive for most countries. Europe's still a little weak, as is Japan, but the US and Australia have recovered particularly well, which is a good sign moving forward. So that's going to cause us to get back to normal GDP. That's going to cause the markets to get back onto a normal growth path. So I've updated the case for rising and falling share markets. Let me go to the case for falling share markets first, because this is the reason that markets have gone up, because we've crossed off the list. COVID vaccination will succeed. We've almost crossed off the list. Politicians gone crazy, but only one particularly. So those two things are what's caused the market to go up spectacularly in November. And we've got past two unknowns. Share markets hate unknowns, and they've now almost passed the unknown of vaccine and the unknown of US federal election. I haven't changed any of the cases for rising markets. We've still got low interest rates. The only thing I changed on this was I've added the acronym. So Emmanuel Calagiris likes this one and talks about often. So TINA, it stands for there is no alternative. So where else do you put your money other than the share market when interest rates are sub 1%? So that's causing, and there is record cash being held around the world. That cash will find its way into the share market and build that up as well. So hence we say the fair market's fair value, it's maybe got a fraction ahead of itself in the last 2 days, but it looks like a negative day as I speak on the 30th of November. So it probably needs a bit of a breather. Traditionally, November and December are good months for the share market. That's partially a statistical flaw, because October had been a bad month on average, because we've had 3 of the biggest crashes in history in October, which drags down the averages. So as we go in, there is one other factor. January is often a good month in the share market. Why? Because people have a break, they come back, and they've just got a better outlook on the world. So we're cautiously optimistic, as always, about the market, just to repeat those long-term returns in line with what we would expect, given what markets have done and given our approach of about 70% index for most of you, with some manufacturing around that, which has done well. The reserves portfolio, where we do have an active manager in there, has done better than cash over that period of time and has stayed positive throughout. It's not spectacular, but it's much nicer to get 2.5% than 0.5%, and that's due to the active management in that bond space, where we do think it adds some value, particularly in current times. Now, property, wow. Property market in Australia is heating up in the last few months. So this shows, and you'll see the month-end value for houses here. So the change month on month, and you'll see some of those numbers pushing up to 6-7%. There's anecdotal evidence of monthly numbers up 10% in November, and we're certainly seeing that in some areas in the Sunshine Coast, and my colleagues in Sydney are telling me there's massive increases, but it's quite widely spread. Areas that you would consider lifestyle areas that have a high attraction seem to be rising, but we're starting to see good increases in property prices, once again completely driven by low interest rates, and a drive towards more lifestyle areas as well. If we look at our friends from Heron Todd White, they've now got quite a lot of cities in Australia in the rising market, start of rising market category, and less in the declining market. Now, this is not a perfect prediction, but I do like it because it gives us an indication of what's to come. Our buying philosophy for property is we like to buy in growth capital cities at a reasonable time. So reasonable time is when the market's not at the peak and declining. So pretty much everything across here. Sunshine Coast is an interesting one. It's hometown. I own several properties on the Sunshine Coast, and I know that makes me biased. I still think we've got a little bit of a way to go, but it's been staggering in some areas how quickly that's risen. But for our younger clients and others that are looking at investment properties at the moment, we're very comfortable in reasonable suburbs in Brisbane. Some may even consider Perth, and Sunshine Coast, Gold Coast, carefully selected as well. And I know for our clients in Newcastle and Sydney, Newcastle is going gangbusters at the moment from talking to clients down there. So be careful as always in property. Do your numbers carefully as much as you can. Lock in rates at 2.5%. Crunch the numbers at 5 or 6 or 7, because that's what you might be faced in a few years' time. There is no sign of rising interest rates in the medium term, but market cycle, there's nothing more certain than that, and at some stage we'll be faced with rising interest rates. The story in units, much the same, plenty of rising markets. And let me wrap up, as always, by just reinforcing our process, which hopefully encourages you to have an exciting life and boring money, and not the other way around. And that's quite simply that all investing is best done as part of a long-term plan that's based on goals that are based on the things that are important to you. Our portfolios are purely designed to meet those goals, nothing else. They're not designed to be exciting. They're not designed to be speculative. They're not designed to predict or trade. They're designed to meet those goals. So we take a long-term view where diversification, asset allocation, and liquidity are critical. We use low-cost index funds for most of those growth markets, as I said, with the exception of some of the bonds and short-term reserves. And the ultimate protection against that short-term volatility, which has worked perfectly, is reserves and dollar cost averaging. So those of you that have ample reserves have not had to sell, and that's all of our clients, by the way, have not had to sell anything during this year to pay your regular payments. And dollar cost averaging, we did some numbers last week, and that was before this week's crazy market. Someone who'd been dollar cost averaging into the share market, the Australian share market, for the last 12 months, even though the market is negative for the year, would be up 20%. So your dollar cost averaging for the year would be up 20%. So it shows the value of volatility for dollar cost averaging as an accumulation strategy. We rebalance regularly as part of that, and as always, there are only 3 ways to lose money in the markets. Panic and sell, that means panicking and sell at a bad time, having to sell because you need the money, and not properly diversified. We don't do any of those things, and as always, encourage you not to do any of those things. This is our second last. We will sneak in a last one before the Christmas break. It's 25 days to Christmas as I record this. You'll probably get our last update bang on about the 17th or 18th of December. And I'm looking forward to seeing friends and family up from New South Wales and Victoria. We've got people booked up already, and I may duck down to see friends in Sydney now that our borders are open. Hope you have a great day, a great week, and until I see you soon, enjoy. Rob McGregor signing out.